So now, welcome to Learning Objective 5. This is really what we're doing today. um, and here we're going to be looking at a cost of good manufactured schedule to see basically how good were we at estimating our overhead for various jobs. Because there's really sort of two things that we uh, kind of can end up doing. We can sort of under apply our manufacturing overhead, or we can over apply our manufacturing overhead. And so we're going to be learning about this in this part of the chapter. Okay. So it starts with the cost of good manufacturer schedule. This is for the month of January. You see it's brand new. There's no work in process inventory to begin with. We have some direct materials that we've used. We have some direct labor. And of course, we have manufacturing overhead that has been applied. Remember, we apply it on that predetermined overhead rate. So that gives us our total manufacturing costs. We subtract out our work in process at the end of the month, and there's our cost of goods manufactured. Okay, so the key word here is applied. So this is because we had to estimate our overhead at the beginning. So once the job is actually done, we kind of know what the actual numbers and costs are. So now it's just simply a chance to compare to see whether we under applied our overhead or we over applied our overhead. So that's basically what we're going to be doing here. It's important to know because it has effects on the financial statements. So for example, whatever we do have for our cost of good manufactured is going to show up on our income statement, right? Because this is going to end up being a cost of goods sold, which is going to impact our profit. Okay. So it's very important that we check and double check these sort of numbers properly. So when we look at manufacturing overhead, there's going to be two possible outcomes at the end of a particular job or period of time. We're either going to have a debit balance in the manufacturing overhead account, in which case we underapplied the amount of overhead to the jobs that we did. Or we could have a credit balance in the manufacturing overhead account, which means that we assigned too much. We over applied the amount to the jobs that we did. So when you're looking at manufacturing overhead here at the end of a particular period, you're either going to look at the assigned costs versus the ones that actually happened. Okay. The differences are what we call under and over apply. So at the year end, we have to make sure that this is all eliminated, okay? And we eliminate the balance by simply adjusting our cost of goods sold, right? So if we under-applied overhead, we go ahead and debit our cost of goods sold. We're simply going to be increasing the cost of goods sold and increasing that particular expense, because in essence, we under-applied it when we did our work. So we really have to add the rest back. However, if we over-applied the overhead, we're going to have to reduce our cost of goods sold by crediting it because we over-applied. We costed out too much of the overhead in those jobs. And so we're going to adjust it. So here is an illustration for Wallace Corporation. They have, at the end of the year, they have a credit balance, right? A credit balance in the manufacturing overhead account. So remember, let's go back to our previous screen here. A credit balance in the manufacturing overhead account, right, means that we have assigned, right, a lot, right, over applied. So what would be the entry because we over applied it? So the overhead, that would be following this. If we overapply to overhead, we go ahead and we debit the manufacturing overhead account 2,500 because that'll get that balance to 0. And we move that credit balance to cost of goods sold. So now the manufacturing overhead account at the end of the year has a 0 balance. So it's basically closed out, which is perfect. And we've moved the credit balance over to cost of goods sold because clearly we overapplied. We didn't have as many costs as we thought we did. Okay. So this is our focus and how we wrap this up. And I'm doing that on purpose because after today, and today's Tuesday, after we finished our homework with chapter 2, which you'll have homework today into Thursday, we're going to do a quick review on Thursday, and then I have the exam for you. The exam is going to be, again, everything's on Wiley, so you don't have to worry about that, but it's going to be opened and ready to go. So we'll have our chance to spend part of Thursday reviewing some of all of these questions that have come up in these chapters. So you are sort of ready to go with the test. Okay. So here is our do it exercise, and it's for car company. Now, if I was back in Boston, because I'm a Bostonian, I moved to New York 9 years ago, I would say it differently. I would say it's car. It's a car company, you know. Hey, what you driving? Where's your car? It's in the yard. Okay. So we have here a predetermined overhead rate of 140% of direct labor for CA. CA incurred $90,000 of factory labor costs, of which 80,000 is direct labor, so that's important to know, and 10,000 is indirect labor. Remember, predetermined overhead is 140% of direct labor. The actual overhead incurred, right, was 119,000. So compute the amount that was applied and determine the amount of under or over. Okay. So the first thing we're going to be doing here is note that the predetermined overhead rate is 140% of direct labor. Direct labor is 80,000. 80,000 times 140% means that we actually assigned $112,000 of costs. Right? However, when you look at the incurred, we actually incurred 119,000. So we didn't apply enough. We underapplied it. We underapplied it by $7,000. And so that would mean, well, that's all your question asks. But that would mean we would need to add the $7,000 over to cost of goods sold at the end of the year. Woo, big lesson today.
So would you write that as cost of goods sold, debited, and then
credit your manufacturing overhead because you want to close that at the end of the year to 0. Mm-hmm. Yeah, that's right.